Investors Chronicle.
Welcome to the Companies and Markets Show. It's Tuesday, the 18th of July as we record, a little early this week, so we are in the dark as to the big macro events of the next few days, such as inflation figures. But with that in mind, we are sticking to our bread and butter, which is company analysis. We will start today with the AIM-listed brick and building products distributor Brickability. Its full-year results were out on Monday. Then we'll discuss this week's cover feature on the secret stars of the FTSE, or at least those companies that are finding the growth that their large cap equivalents sometimes struggle to. Speaking of the FTSE, we are also looking at one of the newest entrants into the 250 mid-cap index, the slightly curious ME Group. Joining me to discuss all of this are Alex Newman.
Hi Dan, how's it going?
Very well, thank you. Mike Fahey. Hi, Mike.
Hello, Dan.
Gemma Slingo.
Hi, Dan.
And over the line, Mark Robinson.
Great to be here.
Good to have you, Mark, as ever. We are going to begin then with Brickability. Like anything to do with construction at the moment, it must be under a bit of pressure operationally, Mike, but how are the figures, which were for the year to 31st of March, I believe?
Yeah, quite good. I described them as like being an island of relative calm in an ocean of tumult. Quite a lot of its peers and competitors have issued profit warnings recently. But Brickability, its revenues are up 30%. Adjusted profits, gross profits were all around the 30% level as well. Its pre-tax profit was much higher, but there's a technicality regarding contingent consideration for something it bought in the past for that. Overall, it seems to have done well, largely because of past acquisitions, I would say. It listed in 2019, and its transformational acquisition was done in 2021. A business called Taylor Maxwell, which, like Brickability, distributes bricks, but also distributed a lot of timber and has timber facades. And that business has possibly been slightly more resolute than the core brick business.
Yeah, I mean, as you say, it does have a couple of strings to its bow. I mean, compared with the brick makers, Brickability obviously a bit more distributor, is more focused on distribution. Do you think that's the reason for the resilience? Is there much in the outlook in terms of being concerned about the months ahead?
The interesting thing with this is that when you talk to the brick makers, the likes of Forterra and Ibstock and Michelmersh, their argument has always been that they are much better positioned than the importers. There has been for quite a long time a deficit in UK brickmaking that demand has outstripped supply for years. Last year, the market total was like 2.5 billion bricks, and there were 500 million imports, and those imports, 20% was were at the highest level they'd ever been. And the argument was that when this market tightens, the lowest cost producers will be the ones that benefit, and the imports will be the part of the market that are worst hit. Now, there is evidence of that. When Forterra put out a trading update last week, they said that the housing market slowdown has meant that overall demand for bricks is down quite considerably. It's down about 30%, but they said in the first 4 months of the year, the amount of imports had fallen by 44%. So, it seems that imports are falling faster than the overall decline in the market. But when we spoke to Brickability, the chairman, John Richards, was saying that it's slightly more defensive than people might think, and that's largely because of the type of bricks it imports. Ibstock and Forterra and the likes make wire-cut bricks, extruded bricks they call them, and they are predominantly the type of red bricks that you would see in buildings in most parts of the country. John Richards said, in general, they're the predominant bricks used in the north, in Scotland, in the Midlands, but a lot of planners in the south of England want a different type of brick. They want these kind of moulded or pressed bricks made from soft clay because that's the vernacular style in local housing. And something like 80 or 90% of all of the imports are this moulded clay brick.
The business split as well. You mentioned timber. I mean, there's other, non-housing aspects to it as well. Does that potentially make it more resilient?
Yeah, so when it first listed in 2019, it generated about 80% of its revenue from housing or home improvements or housing-related activities. And some of the businesses they've acquired, like Taylor Maxwell, principally, it does a lot more commercial building work with some of the wooden facades, etc. Some of the other businesses, it acquired this business called U-Power, which makes a lot of solar panels. And the idea with that is that if they are providing roof tiles, say, they can provide the solar panels that people can install on the roofs at the same time. But there are people who are buying whole fields of solar panels from them directly, not related to housing. And as a result, the overall mix has changed slightly. Richard said they earn about half of the business now from housing, which is obviously, it's diversified quite a lot.
We should still be wary, though, of course, given the macro outlook, given, the uncertainty around housing. It feels like, maybe we'll come on to valuation shortly, but, this, like sectors more closely related to housing, house builders, etc., they can look, pretty cheap, but the macro events can quickly derail any hope of a quick rebound as the year goes on. We're still all waiting to find out what will happen with the housing market, and even at 50% of the business, that's a pretty big potential headwind there.
Indeed, yeah. I mean, valuations in this market, both for the house builders and the builders merchants, they've been hammered since mid 2021, and you look at some of the companies here like Marshalls, and the valuation has come down by more than half. I know there've been, as I mentioned earlier, there've been quite a lot of profit warnings. So you might be looking at something that's valued at 5-6 times earnings, and when you compare it to its 5-year average, or it's even longer than averages, they look remarkably cheap. But the risk there is to the E side of a PE ratio that you've got to ask yourself, if the housing market, which new starts have been bad since Liz Truss's wonderful mini budget last year. So we've had like 3 quarters of a pretty poor housing market, and if mortgage rates are likely to stay inflated, then there really doesn't look like there's any end to that for this year. So if Brickability is still earning 50% of its earnings from this housing market, and this housing market looks like it's likely to be depressed for the rest of the year, then there will be a question mark over future earnings.
Alex, do you have any Brickability thoughts?
Looking at the company, looking at Mike's write-up, it's the first time I've come across them. But I mean, the shares are so cheap on, with everything Mike said, sort of baked into that. I suppose the thing the bull case you might make is, I mean, construction sentiment, is obviously dire, but they are profitable, and the fact they're trading below book value probably reflects the fact that they're a distributor rather than they're in the business of making bricks, where you can maybe put a bit more faith in the value of the underlying assets, because those those aren't going away in the case of their peers like Ibstock and Michelmersh. But I think a long-term view, you could build a case for a sort of compelling value there. I mean, we don't know what's going to happen with the next general election, and planning reform is always the topic which gets kicked down the road. But that could be an opportunity for them if there is some life to be breathed back into UK construction. You would assume it's not going to be from a massive government spending plan. It's going to be from a reform to the way construction permissions are made. So there's lots and lots of big ifs there, but that is, for a company trading at a discount to its net assets, that is one thing I would pin my hopes on if I was going to take a sort of value-based, maybe contrarian take on the shares. That was my thoughts. I also didn't realise bricks could be so interesting. It's yeah.
In terms of just with the valuation, I think there are a couple of plus points with it and a couple of minuses as well. The plus points are it's done a lot of acquisitions, but it is quite cash generative, and it's carrying, its debt levels are pretty low for an acquisitive business. It's only got net debt of 8 million. But on the minus side, the argument that we made when we put Marshalls on a sell last year was that when you look at its acquisitions and its balance sheet, a lot of its assets were in intangibles, which is not something that you would expect from a company that has, that sells building materials, and therefore you would expect that a bunch of its valuation would be tied to physical assets. And with Brickability, it's the same as well. These acquisitions mean that quite a lot of its value is in intangibles. And if, as we've pointed out, there's an earnings risk there, then there's a risk to the carrying value of a bunch of the acquisitions that they've bought.
Well, on the subject of acquisitions, given the valuations we are talking about, and given the fact that, well, we'll come on to whether Brickability might be interested in an acquisition in a minute. But first of all, would it be a potential candidate for being bought by the likes of Ibstock, Forterra? I mean, Ibstock, I think, is work with it as a distributor. Obviously, it's a risky time to be making an acquisition. Equally, we should also say Brickability new chief exec has just come over from Michelmersh, so maybe. Again, maybe there's some potential there. This is all kind of fancy M&A, but are these things to keep in the back of the mind?
The new chief exec, Frank Hanna, is actually I think he's on a 12-month notice period, so he's not going to join until
he's got a while,
yeah, until the first half of next year. But obviously, it's I get the impression it's quite a tight-knit industry, that people know each other, and I'm sure that they're all looking at each other and conversations are being had with valuations at this level. The issue is whether or not you would want to spend the cash on acquiring something like this at this stage. And although the likes of Ibstock and Forterra particularly are much, much bigger players, they've both had some quite big capital programs going on, which in terms of expanding their own capacity, as we mentioned, this market was massively underserved, and both have spent huge amounts in upgrading existing brickworks, which I think, despite John Richards' comments about the types of bricks, it's already leading to decisions being made around productivity levels and whether or not they can maintain enough, or whether there's enough demand to maintain current supply levels. So if they've both spent massively on expanding their own plants, then I don't really see a reason why they would want to buy an importer. Their job surely is going to be to try and get enough custom to fill their own order books.
Mark, just to return to the wider picture, you were looking at some sentiment surveys, I think.
Yeah, I was as well. It's interesting to hear Michael's comments there too. Just on that valuation point, if you wanted to drill down a little bit further, uh, it might be worth looking at inventory levels as well, and that's because making bricks is such an energy intensive process too. It may be that importers don't have to hold so much in the way of inventory. I wouldn't know that, but I think it's something worthwhile if you were going to really, uh, look at the evaluation from a granular point of view. I did look at some survey results from the Construction Products Association, and they fall into line with everything that Michael was saying there. You've seen the third consecutive quarter, they've seen a fall in sales for what's termed heavy side producers. That's things like concrete, aggregate, and of course bricks as well. Whereas the internal fit out, refurbishment, and maintenance market remains pretty healthy as well. And that actually might point to the advantages that Brickability is accruing from that diversification, which Michael alluded to earlier on.
Yeah, well, it's one of those rare sectors where there's lots of listed companies in there, so there's going to be plenty of data for us to keep our eyes on in the weeks and months ahead. For now, though, we are going to turn to our cover story this week, which is on the hidden or secret stars of the FTSE, or rather the companies behind the FTSE 100, if you will. Alex, you wrote the piece. Can you sort of outline the thinking of the piece in a bit more detail?
Yeah. I mean, they're not hidden, or in the sense that we've probably talked about them a lot of these companies on this podcast before. But I suppose they're hidden behind the narrative of UK equities, which, I mean, is often the case. I think that it's a shorthand for the FTSE 100. So even though a good chunk of the businesses in the FTSE 100 are only really UK businesses in a legal sense, or historical accident, given the sort of historic ownership. And if they're coming to market today, it's unlikely that AstraZeneca or Unilever or British American Tobacco would necessarily choose London as their primary listing. But yeah, the FTSE 100, it's a very maligned index, despite, I think, as I'd say, despite its kind of long-term returns, it's kind of held up fairly well when you look on a sort of multi-decade basis. But the chief kind of concern investors have with it is its kind of its makeup. So unless we're going to see a dramatic shift in that, I don't think that's going to happen soon. We can expect it to trade cheaply. Why? Because in terms of sector weightings, you've got about a fifth in consumer staples, a quarter in resources, that being energy and all the big miners, and another fifth in telecoms and financials. So yeah, their cheapness is a function of the businesses that make up the index, and they're cyclical kind of trend growth businesses, and they're going to be priced cheaply. So the more important question, the questions that this raises, I'd say, are one, can these businesses out earn their cost of capital, which I think they can. But secondly, more importantly, whether these are businesses with serious economic moats and that can offer investors a genuine equity growth story, and that's much more debatable. So to get to the sort of the nub of the feature, we wanted to look at businesses which are operating in the sectors that the big FTSE 100 names are in, but which have a bit more of an exciting growth story about them. In some cases, they are service providers to the FTSE 100 companies. In others, they're kind of competing in an odd way at a lower level, or they are potentially taking margin where the sort of mature industry leaders are struggling to preserve theirs.
Yeah, as you say, there is a service aspect to some of these companies as well. We won't go into the names of all the companies. You'll obviously have to pick up the magazine for that. But that service aspect does play to kind of the strength of the UK economy, really.
Yeah, we're as an economy, we're not in relative terms, we're not our natural resources endowment, bricks aside perhaps, isn't enormous, so we're not able to compete when it comes to a lot of goods. But we have an enormous professional services industry, and that reflects some of the strengths of the economy. Being education, those come with trade-offs in terms of higher labour costs, but often services businesses do provide a lot of value add, and for investors, they can have their own structural advantages and economic moats to put a very sort of high level gloss on things. So in some ways, there are reasons when we're talking about the UK economy to focus on these businesses, because these are really where the strengths in the UK economy lie, rather than be it sort of mining, oil and gas, or the provision of ever more commodified products like telecoms.
So on that note, we will just discuss one of the companies briefly, which I think you have singled out an example.
So there's a company which I know Gemma's written about several times before, and I've covered a bit. It's not the most world-shatteringly interesting business, but for the purposes of comparison with the FTSE 100, it's really interesting to see a business that has been a real growth story over the last few years. That company is it's called Alpha Financial Markets Consulting. So one of the things the FTSE 100 is full of is big investment managers and asset managers. And if you're a large fund manager like Schroders or Aberdeen, there are a few big things you have to contend with. One is the long-term growth of sort of lower-cost passive management, which is essentially a product which lots of investing customers prefer. Second, you've got the challenge of offering any sort of outperformance at scale, which becomes essentially impossible when you're managing assets of hundreds of billions of pounds. And then third, you've got the inherent fluctuations in the markets, which can have a kind of multiplier effect when markets are sort of in a downturn, because then it leads to outflows. So even though a lot of money is with these asset managers is very, very sticky, which has its own kind of structural advantages, it's not what you'd call a growth story, and that's completely reflected in their share prices. Alpha FMC is they're a consultancy group which offers services essentially to the industry to try and help them sort of navigate this very, very difficult outlook. And they work with all of the largest asset managers around the world, sort of advising the complexities of compliance, marketing, strategy, M&A, and that sort of thing. And they've grown very, very strongly over the past 5 years, as everyone in the investment industry is trying to understand their own competitive advantage, or whether to kind of fold essentially and merge or acquire other businesses. I mean, putting all this aside, it's debatable whether the degree to which management consultants provide incredible value for money. I mean, by definition, they're not going to turn around the prospects for all of their customers, because this is an industry with its structural challenges. But the desire for and the demand for their services just keeps on growing, because this is what, if you're in a professional services company like an investment manager, and you need answers and direction and strategy, you turn to outside consultants. So the growth story within investment management, essentially, if you put aside passive investing, hasn't been in the big FTSE 100 names we all know. It's been in the kind of services being provided to them. And Alpha FMC is a sort of textbook example, I'd say, of this trend.
Yeah. They need an M&A advisory arm or something, don't they? Say to one business, you need to acquire someone, say to another, you need to be acquired.
Exactly.
And,
yeah.
I'm sure they have Chinese walls in place if that were the case.
They do exist.
Yeah, I mean, that trend, we've seen it again this week with Gresham House yesterday being acquired, albeit that was by a buyout firm rather than a fellow listed company. But I suppose the likes of Schroders, for example, have bought Greencoat Wind, owner of those investment trusts. So you see that kind of diversification, which perhaps, is management's own thinking. Perhaps there's a bit of consultancy thinking there as well, saying, you need to, if you can't compete with passives, you need diversification. At least you need some alternatives arms that are more resistant to that threat. So there's a lot, there's a lot to chew over for these consultants.
Exactly, and Alpha FMC has been successful, and they've tacked on other services, looking at insurance and private markets. I think the issue they face over the next 10 years is when they reach a scale in the same way as the investment managers, it's going to be harder for them to grow. But I don't think right now that's a pressing concern for them, because they're able to sort of chalk up double-digit growth just by expanding the number of consultants globally. So yeah, I mean, scale eventually becomes its own problem, but on the way up, it's much less of a problem. And I think for investors, it's this kind of business which provides a much smarter equity growth story than the big boys.
Yeah. Well, as we say, there are several other examples in the piece, some of which are quite similar in terms of feeding into these big sectors in the FTSE 100. So do look out for that if you see it this week. We're going to finish though with a FTSE 250 business, newly included in the index as of last month, I think, and that is ME Group International. It also had figures out last week, the end of last week. And Gemma, you also took a closer look last month to coincide with its arrival in the 250, because it is quite an unusual business, or certainly idiosyncratic, shall we say, in terms of what it does.
Yeah, I think it's fair to say it's quite a weird business. So it used to be called PhotoMe, which gives more of a sense of what it does, I suppose. So the core business is that it installs photo booths in sort of shopping centres, train stations. And they're the sort of photo booths you'd use to have sort of a passport picture done. But it's been trying recently to sort of push more into different markets. So laundry is its new glamorous ambition. So it has these massive washing machines in various public spaces, and that seems to be, I suppose, a movement away from the traditional photo booth business, which we'll probably discuss in more depth a bit later, but seems to make sense to me.
Yeah, and it's a business which sounds very old-fashioned. The concept of photo booths to some extent are a little bit old-fashioned now, but clearly still growing, as we'll come on to. Likewise, laundry isn't going to excite too many people, but they also have other vending machines, I believe, as well, juice, things like that. And it's quite interesting. We were talking just before we came on air about the geographic revenue split as well. It's certainly quite big in Europe, but it's also got a small footprint in the likes of Japan, which kind of makes sense because they have a lot of novelty vending machines there. I don't know if I'm putting two and two together, making five, but it is spread out geographically. It does have quite a long reach despite its rather limited business lines.
Yeah, and I think its presence in the UK is actually quite small, which is partly why I, for one, hadn't really paid it that much attention before it entered the FTSE 250. But yeah, I was on holiday in France a few weeks ago, and loads of signs of it there. So it does seem fairly scattered. No, it's got a French chief executive, so that sort of ties in with the wider story.
Of course, the reason it's in the 250 is it has been going gangbusters to a certain extent over the last few months. The drivers of that growth, is that coming from expansion? From, I think we'll come on to the capex discussion. I think because it is investing heavily in this this laundry side of things as well. So far, so good it seems in terms of the success of those two strands.
Yeah, so in the 6 months to the 30th of April, revenue was up by a quarter, and it was spread fairly evenly across the business. So photo booths saw sales up by 25%, and that's still the biggest sort of sales generator. And the laundry operations saw sales go up by 37%, so that's growing really nicely. But I think there was just this fear for ages that, particularly in the photo booth division, that demand would just fall off a cliff because you've got smartphones now, and I think in the UK you're allowed even to do selfies for official identification purposes, and lots of other markets allow someone else to take a photo of you on their phone. So there was this thought that people just won't use photo booths anymore. And that does still cast a shadow, I think, but so far at least demand is holding up really, really nicely.
I suppose it depends sometimes on location as well. Like I was renewing my passport the other week and they've got a booth in there. So, if you've got something wrong with your photos for your last minute appointment, you have no other choice. And maybe also there's that, and this is UK only, which as discussed is only about 15% of the business, but, I'm thinking off the cuff here as well, but, passport delays, there's a lot of people getting passports turned around very quickly because of strikes and things like that. So you feel maybe more confident with a booth, you're not going to get your photo rejected and therefore your holiday plan's ruined. I have no idea if that extends to other regions too.
Yeah, I think so. Yeah, you get your holiday ruined at the airport instead. Right?
Well, yeah.
But no, when I was looking into the company, there was something else I hadn't really come across before, but it's known as spoofing. So apparently there's this new way of merging photos of similar looking people, which allows sort of multiple people to be using maybe one passport. And I think governments are getting increasingly concerned about that. So ME Group is fueling money into this anti-spoofing technology. So if you go to a photo booth, you know that it's a legitimate picture. And I think there's this hope from them that actually governments might move back towards that more controlled model.
Yeah, well, could turn from a potential headwind to a tailwind, albeit that might still be a little way off, mightn't it? The expansion of the other side of the business, as you alluded to earlier, it does involve a decent amount of capex. Obviously, washing machines cost money, as do photo booths, I suppose. But what are the kind of signs there of that expansion, how sustainable it is, or at least how much they're putting into that part of the business?
Yeah, so I think I was speaking to the company a few weeks ago, and it sounds like washing machines are way more capital intensive than photo booths. Photo booths, you can basically install them and leave them, and they don't need that much maintenance, whereas as this other side of the business develops, presumably it will start sucking in some cash. But they are expanding their portfolio. But they're hoping, to install plenty of new machines. So on the photo booth side, they've, as I mentioned, trying to create these new, more sophisticated booths. But there's been a bit of a hold up on that, and the rollout is slower than expected. But basically, key to the growth is just getting way more machines out there across their estate. So it's a big push on the laundry side at the moment.
in trying to value a business like this, obviously with several, as I say, idiosyncratic arms, can be tricky. I think Canaccord analysts tried to sort of break down the constituent parts and do a peer analysis with that, which made it look relatively cheap. But is there potential, when you're combining all these things under one roof, is there a discount maybe that should be applied to these kind of companies, this melange of different things? It's not really a conglomerate, but is there a conglomerate risk there, I suppose?
It's hard because there aren't any really direct comparators. So it trades on a forward price to earnings ratio of about 12, which sounds pretty cheap, I suppose. And yeah, one of the analysts I was speaking to basically compared it to sort of a toll booth model. So they install the machines and they just gather cash. But again, that's not really that useful from a valuation perspective. So as you mentioned, there was one analyst who basically broke it down into different sectors. So like looked at concessions, infrastructure, retail, from an enterprise value to EBITDA perspective. And ME Group came out cheaper than all of those. So there does seem like there's something to be seen in the valuation. But I think the big question mark for investors is what happens to the photo division, because to me that hasn't really been cleared up, and there is still this risk that sales will I don't know, decline quite steeply.
Alex, do you have any thoughts on Photo Me, or ME Group as I should call them?
Yeah, I mean they have come up quite consistently in the past year's stock screens, which is why the name and having to fiddle around with the name change has been something I've looked at in the last year. I'm just trying to I suppose understanding that cash flow recycling dynamic in the business. I wonder if one of the advantages that maybe they have is because one photo booth is sort of nominally a very small capex investment, which you can then redeploy without too much pain if it's not a cash generator, which is quite unusual for a lot of capital spending that businesses do. That is sort of fixed in one place, and it's going to be more heavily impaired if it doesn't go to plan. Whereas, I suppose Photo Me or ME Group now is looking at these very sort of kind of micro investments almost, and the ability to sort of redeploy them and learn from their own, sort of understand their cash generation at a very micro level might be one of the ways that they, explanations for their success. I'm slightly spitballing there, but it's an interesting model from something which, like as you're saying, Dan, in terms of how old-fashioned it is, you don't expect it to work necessarily, but they've shown that it can, and maybe vending machines just are the future, and I can't quite see it.
Well, as I say, I suppose there's no limit to what you could sell from a vending machine, in theory. Japan again, maybe being an example here. I suppose maybe that's part of the reason as well. Is it's gone on the radar because there is an instinct, from myself as well, to be slightly sniffy about this odd kind of business, old fashioned. It's not a tech story as we see over the pond, but maybe this is a success story of the UK market. I was looking at the ownership as well. There are some fund managers on there now. Schroders, Fidelity are in there. I don't know how long they've been in there, but so it does have some institutional backing too, which is good or bad depending on what you think. But they seem to own a decent proportion of the shares, so it's certainly something people are waking up to, or maybe have been paying attention to for some time, and they've reaped the benefits from getting in there early. Gemma, I know it's in some ways maybe it's quite similar to For Imprint, which is another company that's really rocketed in recent months, doing slightly unusual things, in that case selling merchandise.
Yeah, I think we just have this tendency to not only look, but to focus heavily on sort of the all singing, all dancing tech stocks. But then you see these weird, seemingly very niche companies that, I don't know, For Imprint, as you say, makes all this printed merchandise and distributes it. Its shares have just been doing amazingly well, and that is another one that features in lots of small cap funds, I think. So I don't know, they're just very, very easy to miss as a retail investor, I suppose.
Yeah, well, they're becoming more obvious, which, again, may be a good sign, maybe a bad sign. Obviously, you've always got to be wary with momentum, but certainly worth taking a look and not dismissing these things when you come across them. I think is the lesson there. That does bring us to the end of today's show, though. Unfortunately, we have run out of time, but thank you very much to Gemma, to Mike, to Alex, and to Mark. And thank you to you for listening. We'll be back next week with another Companies and Markets show.